Hello, everyone. It's super exciting to be here. This is an event in cooperation between Blockchain at Michigan and the Blockchain Acceleration Foundation with the fantastic Maggie Love from SheFi and Bill Warren from MetaCartel. We think this is a very exciting learning opportunity for us and for all other attendees as well to learn about DeFi, DAOs, and the projects that our speakers are working on currently. Blockchain at Michigan in general is an educational organization dedicated to promoting blockchain technology to the students of the University of Michigan and beyond. So we're very happy to be able to host this and to give the floor to Maggie and Bill.
Yeah, okay, I see my screen, so I guess we're good. Okay, so automated market makers, AMMs for you of, also I'm a ex-Big Ten person, so go Big Ten. And I run an organization called SheFi. My name is Maggie Love. You can follow SheFi on Instagram. I do a lot of bite-size educational bits on there, and I try to make them look really nice and have great information about crypto and DeFi. And then Twitter, you can follow my personal Twitter, or you can follow SheFi. It's she__fi. Somebody already had SheFi, so I had to do what I could. And so automated market makers, they're a type of decentralized exchanges where you swap tokens, hence the Freaky Friday. With SheFi, I try to keep the presentations a bit more fun and engaging, hence the use of a great movie, Freaky Friday. And so really quickly, what is SheFi? So it's onboarding more women into crypto. It's a decentralized finance or DeFi educational program. And our mission is to empower women in the area of decentralized finance through education, experimentation, and community. If you identify as a woman and you want to sign up for SheFi, I have a link to the waitlist to learn more, www.shefi.org. Once again, follow us on some social channels. Okay, so the agenda for today, keep it simple SheFi. What are automated market makers or AMMs? If you take away the keep it simple SheFi, you're good to go. Intro to exchanges, automated market makers, what are those as a class of exchanges? Some of the mechanics for AMMs, a summary, Q&A, and a thank you. Okay, so keep it simple SheFi, AMMs. So automated market makers are a class of decentralized exchanges where users execute trades against liquidity pools of tokens instead of an order book of buyers and sellers. So we'll dig into a bit more what that means. Keep it simple SheFi, AMMs. So what are they? They're a class of decentralized exchanges. Who are the users of it? Traders, aka you and me. The action you can perform on it is you can swap tokens, ETH for USDC, USDC for Aave, any type of token really, Ethereum-based token I'm focusing on today, and how you trade against a pool of tokens which holds a trading pair. So if I was trading ETH for USDC, I'd be trading against a pool of tokens that are holding ETH and USDC. Keep it simple. What can you do on AMMs? You can trade between token pairs, like I just said, and you can also provide liquidity, which is capital, to the automated market maker. You can supply your tokens to the protocol to earn fees, and supplying this liquidity allows users to make trades. So if all you take away is that, hey, this is the venue where you can trade between tokens and you can also supply your own capital to the AMM, that's great. That's really all you need to take away from this presentation. Okay, so intro to exchanges. This is an older Freaky Friday GIF. Okay, so types of exchanges. So exchanges are venues to exchange, buy, and or sell crypto. Centralized exchanges, they operate via a single entity using their own software and system to match buy and sell orders, aka trades. Decentralized exchanges operates without a central authority via smart contracts, so code. And so both types of exchanges provide access to digital assets. You can trade crypto for crypto, you could trade fiat currencies like a US dollar for crypto. So that's just to say that both a centralized exchange operated by an entity provides access to crypto. Just because an exchange says you can buy Bitcoin or Ethereum or something else does not mean they're a decentralized exchange. So to dive a bit more into this, centralized exchanges are operated and managed by a centralized organization. They are not built on a blockchain, even though they offer access to crypto assets. They require know your customer and other approvals. That means like verifying your license or your passport or other things about your status, and they custody and hold your assets for you. So you need permission to withdraw your assets. So you do not actually manage the crypto that exists in Coinbase. Coinbase manages it for you, even though if it shows in your wallet, they have the ultimate control. And you have to sometimes, when you want to send your crypto somewhere else, you have to like wait an approval period. Decentralized exchanges, on the other hand, are run by code. They are built on a blockchain. So they operate on blockchain. Know your customer is not required. They're non-custodial, so they do not hold your assets for you. You maintain control of your assets. And they have decentralized governance, which is management of the platform. And Bill's going to go over this topic of decentralized governance and DAOs even more. Star here, many of the platforms are still centrally managed, but they're really working towards this decentralized governance. So types of decentralized exchanges. So you have order book based and you have automated market makers. On the left, you can see some names of order book based. And on the right, you can see some names of AMMs, popular ones, Uniswap, Curve, Balancer, 1inch. They're actually all pretty popular. So it's cool to see that both types exist. So what is a decentralized exchange, an order book based one? So what it means is users place buy and sell orders at a specific price or market prices. There must be a counterparty. So there must be someone buying what you're trying to sell and someone, or there must be a buyer and a seller, right? There must be somebody on each side of the trade for a trade to execute. And this way, liquidity can be an issue. So, you might want to sell a token for a certain price and there may be nobody that wants to buy it. So that can be a problem. There might not be enough demand for a certain type of token on an order book based exchange. So simplified, user trades with another user on a platform. And there's some examples. And so before we get into automated market makers, I wanted to talk why order books aren't optimal for decentralized exchanges. So they're not the native architecture for implementing a liquidity protocol. So having, a lot of capital existing on a decentralized open blockchain. And they require this intermediate infrastructure, right? They require hosting the order book. And that means there's points of control and layers of complexity. And they also require active participation and management of liquidity. So this means it's usually by sophisticated traders using complex algorithms, limiting participation, right? So the technical architecture is not optimal. And then there's also this idea of limiting who can actually really benefit from trading on an order book exchange because it's, leans to more sophisticated traders. So this is where automated market makers enter. And so decentralized exchanges that are automated market makers are what we call liquidity pool based. So they're not order book based, they're liquidity pool based. So tokens are pooled into smart contracts. Users trade against these liquidity pools. Each pool holds a pair of tokens, so ETH, USDC. Mathematical formulas are used to set price assets in these pools, and trades always execute because a pool is a 24/7 available counterparty. So there's always a buyer and a seller. There's always a counterparty ready to take a trade. Simplified, user trades with a smart contract that manages a pool of tokens. Some examples on the right, you can see my pool, my smart contract holding my ETH USDC pair. So that's really what is happening on an automated market maker. And really quickly, with SheFi, I always explain where these terms come from. So with SheFi, it's not just about decentralized finance, but making sure we know where these terms come from in traditional finance. So where does the term market making come from? So market makers is a financial institution that is always ready to be a buyer or seller of a security stock at the quoted bid and ask price. So a market maker is a guaranteed counterparty. They commit to continuously quoting prices at which they will buy and sell securities. So once an order is received from a buyer, the market maker immediately sells off her position of shares from her own inventory to complete an order. So let's bring this into automated market makers and the benefits of automated market makers. So just like a traditional financial market makers, AMMs have guaranteed counterparties with inventory, but by leveraging liquidity pools, not financial institutions. So a smart contract pools of tokens is that market maker. So AMMs solve for liquidity bootstrapping and liquidity issues for decentralized exchanges. Furthermore, AMMs remove the need to find counterparties like that financial institution. They operate 24/7. They're permissionless, which means anybody can access them. And they use mathematical formulas to automate the pricing of assets in a pool for a trade, which we'll get into more detail. And really quickly, this comes up a lot. So like, how does pricing of assets work in traditional finance? And then how does that relate to these two different types of exchanges? So this is simplified, right? So on like the stock market exchange, stock prices are driven by supply and demand for a stock. When a stock is sold, the price for which it was purchased becomes a new market price, and you repeat that process so on, right? There's all of these reselling of it in demand and supply. So on order book exchanges, in the order book, you can see the volume of orders at each price point for the sellers and the buyers. So you see that supply and demand, and that's, you know, how these trades are matched. And AMM exchanges, right? We've been through this a couple of times now. It pools tokens together for liquidity and uses algorithms to quote prices to the end user according to some predefined formula, also based on supply and demand. And so there's no human order books required for automated market makers. And AMM mechanics, so we're going to go a little bit deeper on pools, on liquidity providers, and these mathematical formulas for market making. And that's diving into a liquidity pool. So liquidity pools, tokens are pooled into smart contracts, aka liquidity pools. Each liquidity pool contains 2 tokens in a trading pair. And so the relative percentage of each token in a pool is what determines the theoretical price of a particular asset. Pools match buyers and sellers of tokens, right? There's no order book. It's this pool with this pair waiting to make a trade. Anyone can take part in supplying assets to the pool and be rewarded for supplying this liquidity. And this is what we call liquidity providers. And so the role of liquidity providers, right? These pools, the tokens in these pools are supplied by liquidity providers. So these liquidity providers are incentivized and rewarded to provide tokens to the pools. Some of these incentives include earning trading fees from all the trades that happen in a pool the LP provided liquidity to. A lot of liquidity providing term repeated. So I can provide liquidity to the ETH USDC pool on Uniswap. I have to provide both tokens, and every single trade that happens against that pool, every single person ever making a swap between ETH USDC, I earn a fee on that along with everybody else who supplied liquidity, right? So anybody can be a liquidity provider. And so like this is really an important thing, right? So liquidity exists on these automated market makers by allowing anybody anywhere in the world to provide their tokens that they already have sitting in their wallet and earn money from it. So that's a huge benefit. It's permissionless liquidity and allows like bootstrapping of liquidity if you launch a token to be easy. And then, you know, it kind of solves for all these like needs to find market makers or this idea that there's not enough liquidity on an exchange. Liquidity can be added and removed at any time. So liquidity providers aren't locked into needing to provide liquidity for a certain period of time. And so incentivizing liquidity providers to deposit tokens allows for permissionless, like I said, bootstrapping of liquidity for tokens. So there are risks with being a liquidity provider. It's called divergent loss or impermanent loss. So potentially after some time period that I supplied my ETH and USDC to a pool, the value of my stake in the liquidity pool is worth less than what I initially put in. So basically what impermanent loss is, the opportunity cost when providing liquidity for an asset that experiences price appreciation. So it's the trade-off between providing liquidity to the ETH USDC pool and just holding my ETH, right? So ETH is a price appreciating asset, as you know, and as we all hope. And so I can provide liquidity and I can earn trading fees, but sometimes like it would have been just more beneficial if I had held ETH and had it do the price action. It's really hard to go into detail about this. So if you want to join SheFi, I can go a little bit deeper on it. But it's impermanent because if the price of ETH, you know, returns previous levels, the loss is reversed. So basically, you're always taking an opportunity cost when you provide liquidity of a price volatile asset than just holding it because of some of the mechanics behind how liquidity providing works. Okay, and finally, how automated market making works. This is the, so AMMs implement a constant product formula. This is the one specific to Uniswap. So the number of X times the number of Y always equals K, right? Number of X tokens times number of Y tokens always equals K, the invariant. So K is a fixed constant that doesn't change when the amounts of X and Y changes. So K means there's a constant balance of assets that determines the price of tokens in a pool. So the smart contract prices the two assets so that the number of units it holds of each asset in the pool multiplied together is always equal to the fixed constant. So basically, I just described a couple more ways of saying K needs to be maintained no matter of what the number of tokens of X and Y are. So it'll price that trade to make sure that K doesn't change. Okay, we're going to do a very simple example. So let's say there's a pool of 50 apples and 50 bananas. So 50A times 50B is 2,500 K. So Danny buys one apple and the pool will be left with 49 apples and 50 bananas. But how many bananas do we need to keep the 2,500? So she buys one apple. You know, here's the math, 49 times B equals 2,500. You do the division. So 51.02 bananas. So if we take 51.02 minus 50, we need 1.02 extra bananas. So the pool needs 1.02 extra bananas for that apple. So that means an apple costs, 1.02 bananas. And so you can see the examples of different trading sizes. So basically this, what this is saying is, no matter what you're buying, that constant product function is always doing the multiplication to make sure it's returning you a price for whatever you want, to maintain that K, that invariant number. So an AMM cannot deviate from this pricing curve in maintaining the invariant number. If someone wants to buy some apples and later somebody else wants to buy some bananas, the AMM will sweep back and forth through this pricing curve wherever the demand carries it. Sorry. And so this is just about, the importance of AMMs and their architecture. So a blockchain native liquidity protocol should take advantage of the trusted code execution environment, the autonomous and perpetual running virtual machine, the Ethereum virtual machine, and an open, permissionless, and inclusive access model that produces an exponentially growing ecosystem of virtual assets. Okay. Summary, not next session because you're not in SheFi, but summary and Q&A. So automated market makers are a class of decentralized exchanges that rely on mathematical formulas to set the price of a token and to quote prices between two assets. So they deploy smart contracts, which is code, to act as a market maker, standing ready to accept one token for the other as long as the constant product formula is preserved. X times y, the number of X times the number of Y equals K, constant product formula. We know that this formula prices the two assets X and Y, so the number of units it holds of each asset multiplied together is always equal to the fixed constant. Smart contracts are liquidity pools of token pairs. And so once again, automated market makers, just went over some of the math. I won't bore you with that. Arbitrageurs also play an important role in these AMMs. So they help keep the exchange rates, between tokens constant as well. Liquidity pools, our pool is a reserve of tokens in a smart contract that a user trades against. So it's a counterparty, and this solves for the liquidity problem of order book-based decentralized exchanges. And liquidity pools, it's a pool, smart contract made up of trading pairs. Each pool acts as an automated market maker, and the relative percentage of each token in the pool is what determines the theoretical price. Providers, anyone can be a liquidity provider by adding tokens to pools. Liquidity providers are rewarded with swap fees from the pool they contributed to. And, there's a risk of impermanent loss, not permanent loss. When the price of an asset changes, it changes the exchange rate between the two assets in the pool. So that is it. Thank you for having me.
Thank you very much for that awesome presentation. And before we move on, I would like to Q&A part of the DeFi side of this event. So we have one question in the chat, which is there a reason why decentralized order book markets are not a possible alternative solution? Each agent could post bids and offers and or accept already posted ones.
So sorry, there are order book decentralized exchanges. Sorry, did I miss the first part of that question?
I think the question, and of course this is only my understanding of the question, but from what I understand, it's not as much about the fact of the existence of those decentralized order book exchanges, but rather why maybe they aren't seen as an alternative solution quite to the same degree as automated market makers, perhaps.
Yeah, so sort of like I went over in the presentation, it's like the infrastructure of a blockchain, of a decentralized the technology of blockchain, being this like distributed nodes, right? Just like the order book is a centralized piece of infrastructure technology. So it doesn't really function as well on a decentralized underlying infrastructure. And it's just, it limits the amount of participation. Like anybody can provide liquidity to Uniswap. On an order book, like, yes, you could provide liquidity, but right, you have to have the amount of liquidity for that buy and sell order. So you can contribute a little bit of liquidity to a Uniswap pool and earn fees. But if you need to sell, if there's an order for ETH at like 3,000, whatever, you have to be the liquidity provider, the seller, the buyer to match those orders, right? So it limits who can actually participate. And it's a very sophisticated to participate in these environments. So the idea is in order to get the most liquidity on the platform, you would make it easiest for people to participate in those liquidity providing strategies, which is just providing to a pool, if that makes sense. So it's not that order books aren't used. There's actually like 4 or 5 order book exchanges. But there's points of controls, there's centralization, and there's always risk of centralization. And so that's one, and just like allowing everybody to participate, to make trades easily, to, potentially provide the grander scheme of the exchange via liquidity. It doesn't really work with order books as permissionlessly and easily as it does with a automated market maker.
We have one more question in the chat. How does automated market maker address know your customer anti-money laundering?
It doesn't, no. So this is like a funny, complex, sorry, it's not a funny question, but it's like a complex question, right? So if you download MetaMask and you can access Uniswap or you can access Balancer, there is no trading, there is no passport verification, identity, all that stuff. Versus if you go onto Coinbase, before you make a trade, you need to verify your identity, where you live, blah, blah, blah. However, everything on a blockchain is recorded on a publicly distributed ledger. So this kind of idea that AML really exists on a public ledger, which everybody can see. And if somebody does find out what your address is, can come find you. Like that is, I'm not going to say that nothing bad ever happens on a blockchain network. But it's just like, it's not the same. But I think this is like a shift, right? Like right now there is subjectivity in allowing you onto a centralized exchange and allowing you to do things in the traditional financial world. If you have to go in person, everything is subjective. Whether or not you're an accredited investor, whether or not you can you have the right amount of wealth, what you look like all those things can be used against you. When you're on Uniswap, you have your MetaMask address. It shows you the price of the asset. It allows you to use the technology. There is no subjectivity and no playing favorites and no being like, oh, I don't know, we're going to charge this person a higher fee. Not that really happens on Coinbase, but everything with DeFi is you see the rules in front of you of how things work and everybody gets the same rules. Versus onboarding, KYC, all that stuff in any traditional financial service entity, there's definitely subjectivity involved. We know that it's not fair and equal and accessible to all. So that's why we don't like KYC in crypto, because we want everybody to have the same rules when it comes to interacting in this new financial paradigm. Kind of like a tangent, but that's how I feel about it.
Thank you very much for that answer. I also have one question for you, which I think should be the final question for this segment of our event. So could you share your opinion on the future of DeFi, specifically in terms of its relationship with centralized exchanges and how that relationship is going to evolve and transform going forward?
So I read a really great article that decentralized exchanges don't mean the absence of centralized exchanges. They each fulfill different roles. And right, Coinbase or Gemini has super easy on-ramping, paying with your credit card right away, no matter what. This is United States specific because it's what I know, no matter what state you live in. Versus MetaMask swaps, which is actually decentralized exchange within your MetaMask wallet. I live in New York City, so I cannot buy crypto with my credit card unless they get this thing called the BIT license. So that makes it really hard for onboarding. The BIT license is a terrible regulatory governmental rule in New York. So that shows you how they work. And then like centralized exchanges and decentralized exchanges, like they work together. There's rules of arbitragers. There's like all these other things going on in the background. And like, some people might be don't want to manage their crypto in their keys, and that's fine. And they trust entities, right? So, I don't have like a perfect example. While, I can say as somebody who is like 100% a crypto like believer and like wants to manage my stuff, I don't keep things on centralized exchanges. Like I keep things in wallets, and I use DeFi. But I especially say this with SheFi, like it's your money at the end of the day. So if you prefer to where you prefer to keep it, and the things that, as long as I share with you, like here's the risks of kind of each, or here's what you should know, then it's up to you because it's your money. But yeah, there's no world where like, Coinbase and Binance and Gemini go away and like everyone's using Uniswap. Especially things like Ethereum gas price fees, like technically Uniswap fees should be cheaper than Coinbase, but then you're paying the Ethereum gas fee on top, right? So then sometimes Coinbase fees are better. So, there's like all these different things, and it'll always be evolving over time. But I think the cool thing about crypto is everyone has this mission to get crypto into as many hands of people as possible. And so, sometimes centralized exchanges have like the legal and the operational infrastructure to do that, in certain ways. And, DeFi, you just need a cell phone. But like, there's other ways where like DeFi does it as well. But there's like what we're all against, not against, I should say, but like what we all want is to disrupt traditional banking and Wall Street. So if any of you Michigan kids are thinking about going into banking or Wall Street, you should consider crypto instead, because it's the future.
Thank you very much for that very detailed response and the message. I think we're gonna move on to the Decentralized Autonomous Organizations part of today's event. So Bill, the floor is yours.
Awesome. Yep. Let me share my screen and find the right screen to share, because most people in crypto have way too many windows open at once. So my name's Bill Warren. I'm the executive steward of product and technology at Opolis, which just means that within the flat organization, which is Opolis, I kind of lead our technology and product team. Opolis kind of inhabits an interesting role in the DAO space. So what Opolis does is it provides payroll, benefits, shared services, tax compliance for what we call the self-sovereign independent worker. But really, we mean kind of like freelancers, and especially freelancers that work for DAOs, because unlike a lot of the other companies out there that handle payroll and tax withholding and everything for freelancers or other workers, we accept crypto. So if you get paid all in crypto, you can use Opolis to cash out what you need for the government so they don't come after you, and then take the rest in cash or like USD, or keep it in crypto. One of the nice things that we also do is, even if you get paid by all of your clients in USD, we can pay you out your salary partially in crypto, which means that Opolis is actually a really effective and inexpensive onboarding ramp to crypto, because like Maggie was mentioning, sometimes Uniswap or Coinbase comes with high fees. Because we kind of do like bulk orders, we have a discounted rate on the fees. So we're able to pass that along to people that use our service. But Opolis itself is a DAO. So, I think what we're seeing in the DAO space is more and more organizations are organizing themselves as DAOs. So what is a DAO? A DAO is a decentralized autonomous organization, or I like to call them magic internet communities. If you're thinking WTF, that's totally fine. I think the term DAO is like super technical, and people always get tripped up by the autonomous part, because in a lot of ways DAOs are the opposite of AI, because it's really about individuals within a community making decisions. So it really puts a premium on participation by the individual in order to drive a community forward. So, when you think of a DAO, what it really is something like a subreddit or a Facebook group, a bunch of people on the internet that have come together because they share some interest or want to do something together. But unlike a subreddit or a Facebook group, they're able to manage a shared treasury. So actually like pool some crypto together and then deploy that crypto, like spend it via on-chain decision making, which is usually in the form of voting. And that means it becomes a very powerful tool, because you go from just a community that, might coordinate online, but not have a ton of power to move money, or has to rely on like a treasurer or some kind of centralized entity or person to manage the group's funds, to a system where a group can manage funds completely together with full transparency and with a lot more certainty that somebody won't run off with the funds in an unexpected or unanticipated way. And a lot of times it also gives the members a right to exit with their share of the funds. So if you join a group and you put your $10 in crypto in, you figure out, well, this group really isn't for me. You can often take your $10 or some pro rata portion of it with you to the next group. I think the reality is that DAOs are split into decision-making types. So, all DAOs manage treasuries, right? That's kind of their commonality, is they're groups of people on the internet that manage treasuries via smart contract, so that you're not relying on a centralized entity. How the decisions are made is really where DAOs differ markedly. So within the market or space right now, I think of three different types of DAOs. There's the representative DAO, which in terms of tooling uses something called a Gnosis Safe and Snapshot. And so the reality of that is, in Gnosis Safes, you have, but usually between like 3 and 7 people who are signers. And then a majority of those signers can, sign off on the movement of funds. But in order to be more inclusive of the community, there's also usually this tool called Snapshot, where the larger token holder community can signal their will, and then the signers on the Gnosis Safe actually queue up the transaction and sign off on it. So to me, that feels a lot like kind of representative democracy, where you might have polling on issues and stuff like that, but then there's some kind of like elected or appointed official actually executing on the plan. The next is permission DAOs. So these are the ones that I work with most or have worked on building. DAO House is the main tool, and Moloch DAOs are the kind of smart contract layer. And what these permission DAOs are, if you're familiar with like LLCs in the typical world. So I was a corporate lawyer, so I come from like that legal entity space. But permission DAOs are essentially kind of like clubs or LLCs. Basically, what it means is the group, everybody in the group has a say in every decision the group wants to make, but you have to be not invited, but you have to apply to become a member, and especially a voting member of the group. So it's not like you can just kind of like pick up the token on a decentralized exchange and all of a sudden kind of have a say in a community. Instead, you have to actively be voted in to a decision-making role. And so that means while it's much more decentralized than a representative style DAO, where you kind of have a small subset of people kind of executing the transactions for you, it is kind of more restricted than the last form of DAO, which is a tokenized DAO. And, Aragon or DAOstack are kind of examples of tokenized communities. And in those communities, a lot of what happens is everybody that holds a token has a vote equivalent to the number of tokens they hold. So, if you go off to an AMM and buy, X number of this group's tokens, you can then come back to their Aragon DAO and use those tokens to vote on decisions, how to spend funds, or, queue up proposals on how to spend funds, etc., without anybody giving you permission to join the group or vote or anything like that. So in many ways, they're the most decentralized. Kind of which communities pick which, it is more a function of the type of community. And I'd say a lot of communities still aren't probably picking the optimal type for them. So in the DeFi space, you see a lot of the kind of representative style DAOs where, the core development team kind of holds the keys to the Gnosis safe and are the ones actually executing all of the transactions and holding that onto that power. But they've set up a snapshot so that so they can essentially kind of poll all of the token holders in their community before the core devs make a decision. But that poll doesn't force the core devs to do anything. It's more of a just kind of like trusted relationship that the core devs will execute the transactions the way the community votes. Permission DAOs, the type of DAO you see end up as a permission DAO are a lot of the grant giving DAOs and venture DAOs out there, because you kind of want to limit participation in the DAO to people that share the same ethos or maybe meet accredited investor status if you're doing a venture DAO. So you can't just have like anybody coming in and pushing the group to spend its money one way or another. Tokenized DAOs, they seem to have fallen a little bit out of favor. I think partially because Aragon and DAOstack, and this is just my bias as a DAO house dev, but Aragon and DAOstack are really kind of complicated and clunky to use. So that, you don't see quite as many pure tokenized DAOs anymore, but they are out there. Here's the DAO infrastructure stack. I think this photo does a decent job of providing a snapshot, but you can see kind of at the bottom what the frameworks are. So the frameworks really refer to the types of smart contracts that underlie the DAO system. Moloch is the one that I work on. It's a pretty simple single contract system for permission DAOs. Aragon and DAOstack, like I mentioned, are really built for more tokenized DAOs, but they're pretty big, complex smart contract systems. The same with OpenLaw. They have kind of this modular smart contract system where you just kind of keep on plugging things in to reflect the rules of your community. Snapshot is, again, kind of just like token polling and voting. Controllers, that's really focused more on kind of like the UI you use to interact with the DAOs. Treasury, that that's where the funds are held. So again, kind of in these representative style DAOs that have become really popular, you have a Gnosis safe where the treasury lives and the signers on the Gnosis safe, but then you have Snapshot for the actual token holders to kind of signal their demands, versus within a Moloch DAO and even Aragon and DAO Stack and OpenLaw, the treasury is the same smart contract that controls the voting. So those are a little bit more tightly coupled, and that's kind of where this graphic breaks down a little bit. One thing that's been actually kind of neat as the DAO system has evolved is that they're actually now like aggregators. I'm a member of, I don't know how many DAOs exactly. I think like 14 DAOs that do different things, and I'm involved to like different extents in each of them. So aggregators like Boardroom or Tally are actually being built for people like me who are in a ton of DAOs and need to manage all of the governance decisions that I've signed up to manage. And then finally, here's kind of the DAO landscape. And I just wanted to show this mostly to demonstrate kind of how popular DAOs have become and also the different types of DAOs. So the operating systems, we've kind of talked about those. Those are really around like the smart contracts and how the DAO works. But, these protocol DAOs, really, these are all like token communities or DeFi communities that are run by some sort of DAO. The service DAOs are DAOs that work on projects together. So like Raid Guild is a decentralized developer cooperative. Deorg is another that I've worked with. LexDAO, where I'm a member, it's a DAO that provides legal engineering advice and help to others on chain. Collector DAOs are people that come together to buy NFTs. Grant DAOs are, like it says, people making grants. Investment DAOs, people making investments. Social DAOs, just clubs. So there are a lot of different kind of DAOs out there to, fill whatever your interest is, really. And I'd say, to Maggie's point, if you're thinking about banking as a career, don't do it. Get involved in the Web3 space and join a DAO that's building something that, it's actually the DAOs that are replacing companies in the Web3 space. So if you want to go build the next generation of DeFi projects, you're probably going to do that as a member of a DAO rather than kind of the member of some venture-backed startup. So that's it. I will turn it over.
Thank you very much for that presentation. That was a lot of information, really awesome stuff. Still trying to wrap my head around some of it. But one thing I was curious about is that you mentioned how, in terms of governance models of DAOs, tokenized DAOs have kind of fallen out of favor recently. And that really got me curious about what your vision is for how that's going to progress in the future, what you think the standard, so to speak, governance model for a DAO will be like. Do you think this trend will continue, or perhaps we're going to move back from more decentralized DAOs towards some sort of centralization? Do you think that it is possible that tokenized DAOs will make a comeback? What is your opinion?
Yeah, so I think tokenized DAOs will actually make a comeback because I think a lot of the representative DAOs want to be tokenized DAOs. It's just the tooling for these purely tokenized DAOs were really, really clunky. They were some of the first DAO platforms developed, and they were leaders in the industry and did a great job, but they never really kind of evolved to match the UX needs of communities. So one of the projects I'm working on is making Moloch DAOs, which are very much permission DAOs, a little bit more tokenized so that they can address that kind of gap in the market where people that have organized around a token as a community can start to manage a shared treasury in that much more decentralized way without having to deal with a giant kind of modular clunky DAO framework. Instead, they can have a pretty simple single contract and UI, and then get as complicated as they want as they grow or evolve as an organization.
All right. Thank you very much for that answer.
Yeah.
I don't think we have any other questions for... Oh, actually, no, we have one more question in the Q&A we forgot to address. It's for Maggie.
Yep.
Do you know any DeFi automated market maker product on other chains?
So I don't. There's a lot of DeFi happening on Solana, on Binance Smart Chain, and I think some stuff is starting to happen on Ava. But I cannot tell you the specifics of whether it is an automated market maker or something else. I'm an Ethereum at the moment. I'm just like I can only teach so much and do everything else I'm supposed to do. So I haven't dug into everything, how like PancakeSwap on Binance Chain works or some of the stuff on Solana. But there's definitely stuff out there.
Yeah, and Binance Chain is what they call EVM compatible. So it's really just a copy of Ethereum. So I think I include that in like the Ethereum family, even though it's not super decentralized.
Yeah, there's a lot of things you have to consider as well when you're examining other chains and what matters to you. I won't go on another like passionate, whatever. But yeah, I think if you want to play it safe to start and get used to some of these protocols, I would definitely start with Ethereum just because of the battle testedness and the architecture, and then maybe look at if some of these big Ethereum projects are going onto other chains, then maybe try those. I cannot speak for anything else, so I do not want to vouch for it.
Awesome. So before we wrap up, I really would like to thank you, Maggie and Bill, for this really awesome educational event that we've been able to host. I want to say I feel very privileged to be, well, maybe not in the same space, but in the same online space as you two right now. And I really think this was an awesome day, and I really, really think that a lot of people in blockchain at Michigan and beyond are going to be able to learn from it. So thank you.
Great. Thank you.
Yeah, thanks for having us. Bye.
Bye all.